Hello everyone and welcome to today's Do More With Your Money podcast. I'm delighted to be joined by three of my colleagues from the investment team, Faye Graham, Paul Durrans and George Bell. And today is all about the US election and the new president-elect, Donald Trump. So we're going to walk through what are Trump's policies, how could they affect investment return, and how could they affect your money. So Faye, maybe let's just start with Trump and just bring out some of the key policies that he's discussed.
Yeah, so there's quite a lot to digest really. So what I'll do is just probably focus on really the policies that are relevant for markets. So, you know, tax cuts, tariffs, some of the deregulation as well, and also tighter immigration control. Really the key ones that are relevant for asset markets. And the very pro-growth policies, very also pro-domestic US policies as well, domestic US business. So looking at corporate tax cuts, he's proposing to extend the tax cuts and Jobs Act that he first put in place when he was first in the president in 2016. So that would be extending that 21% corporate tax rate. And he's also talked about lowering that to 15% for businesses that make their products in the US as well. So very, as I say, pro-domestic US business. Particularly as well would be beneficial for those smaller companies that tend to be a bit more domestically focused rather than those more sort of large cap multinational companies. So you've seen the market react to that as well, with sort of the smaller companies outperforming those larger companies. On the day yesterday, and that should be a positive for US growth as well. So obviously companies' costs will be lower, so that should boost corporate profits. So they'll have more money to invest in new technologies and growth, and that should really drive economic growth as well. If we move on to tariffs, obviously he's proposing 60% tariffs on China. And also tariffs on other regions as well, so imports from other regions as well. So he's put them in to sort of try and preserve and boost domestic US business, particularly the manufacturing sector, which is currently, you know, quite heavily dominated by the likes of Asia. So again, it's a pro-domestic US business policy, should be quite positive for US manufacturers and US growth, but you might actually see that be a little bit of a headwind for the likes of Europe or other exporters to the US, given tariffs could potentially reduce their export sales to the US. And as companies sort of adjust and perhaps move towards more US suppliers to keep the prices competitive. Obviously, European growth is a little bit on the weaker side already, so that's potentially another headwind that we could see for Europe there. And you've also got the inflation impact of the tariffs as well. So obviously, tariffs will increase costs for those US importers when they are importing goods. So they can either absorb these costs, which will obviously negatively impact their profit margins, or what's probably more likely is they'll pass those costs on to consumers by charging higher prices. So obviously you've got the inflation impact there as well. But the extent of that will depend on how much of those costs that those companies can pass on to the end consumer.
I suppose just on that, I suppose if you think about tax cuts and perhaps greater profitability, they may be able to pay their workers perhaps more through higher wage growth, and therefore be more willing to pay tariffs, perhaps or perhaps not. So, but on the margin, it should be more inflationary.
Okay. Excellent. So, in summary, describe it as the policies are business friendly, very, very US focused. You know, there's kind of very much a protectionist view around the US overall, and potentially maybe inflation slightly ticking up from where we are right now.
Yeah, exactly. And if you think about that, stronger US growth, potentially higher inflation, that also means potentially less interest rate cuts from the Fed as well. They're not in a position where they potentially need to cut rates as much, given you've got stronger growth and also potentially that higher inflation as well.
Good point.
I suppose the challenge for the Federal Reserve, expected to cut interest rates between now and the end of the year, but also into next year. Clearly, there's a lot promised by Donald Trump here, and looks like he's going to be able to push through a lot of this. But it's difficult for what's meant to be an independent body, the Federal Reserve, in terms of how they navigate interest rates. Certainly more problematic for them.
And Paul, maybe just sticking with interest rates, just thinking around the number of interest rate cuts that are now priced compared to, say, a month ago. Are there now less interest rate cuts priced?
Significantly. I think if we look at markets pricing over the next 12 months, we're looking at about 3 to 4, 0.25% interest rate cuts. Go back 4 to 6 weeks ago, we were looking at more than double that. So it's certainly changed. Markets reappraised how many interest rate cuts can come through, given how strong the economic data has been. Inflation's been relatively benign, but it's the growth data that has remained remarkably strong. So reprice that out, and that's come through when we look at how bond markets have performed.
Excellent, thanks, Paul. And in some ways, we've kind of been here before, in the sense that obviously Trump was in power at the end of last decade. George, maybe talk about where there's been some similarities, but also maybe where there are some differences now compared to that time.
Well, stock markets were very strong last time Trump was in office, all the way up until the pandemic, where things changed. But the market reaction has been sort of suggesting Trump will be good for US domestic economic growth with the measures that he's putting in place. But things are different. The world's different. They're coming off the back of a massive inflation shock. The starting point, therefore, of interest rates as he comes into office is very different. Interest rates are at 5% rather than 0.5%. So that's a very different starting point. The labour market's stronger at the margin. Less ability to maybe claim success in terms of strengthening the labour market further. It's quite tight. If we look at the labour market relative to historical levels, and there's more debt. So if we think about debt as a proportion of the value of the whole economy as GDP, it's moved from sort of 90% when he came in 2016 to over 100%. It's about 110% now, and we've got these issues ongoing with the debt ceiling limits, which just keep getting pushed out and kicked down the road. But the cost of financing that debt from the government is higher as well. So the starting point is quite different economically, and from a market perspective, the stock market's higher. It's 3 times higher. The S&P 500 was around 2,000 in 2016. It's very close to 6,000 at this point in time. And when you buy in units in the stock market, what you're paying for is, units of profit growth, and what you're paying for that profit is higher now. It's around 30% higher than what you're paying in 2016. What I mean by that is, if we talk in multiples, the S&P 500 has got a price to earnings multiple of around 22 times. It was 17 times, so it's a more expensive market. And it's quite remarkable that that's happened, given it's not as if earnings and profits of businesses haven't grown. Yeah. We've actually seen profits, so earnings per share, increase by about 60% during that time. So it's quite a different marketplace to when he first came into office. And I think in general, the market is still digesting this as a set of policy measures which could continue to be a tailwind for the US economy. So if we think about our view, Chris, within equities, we are overweight relative to a neutral portfolio, and our key channel of getting that exposure is through the US. So within the developed world, it's the market with the strongest level of nominal economic growth. So the growth of the economy, it's got one of the strongest engines out there. We're seeing corporate earnings which are expanding. Now, the measures which Faye's discussed should be supportive for corporate profits. Lower taxation is a key example of that. You've got some of the highest quality businesses internationally within that marketplace, businesses which have adjusted their own balance sheets since the pandemic to make sure that they are, of higher quality than where they perhaps once were. And we get that the market is more expensive, and that's why when you're accessing the US, you need to do it in different ways. You can buy, part of the index, a lot of the strong fundamentals which underpin the reasons for that, but you can also access parts of the market which are perhaps a little bit cheaper but offer very good return opportunities as well. So the market has done, a lot of the talking and said that actually they believe that the policies which could come in place could be very good for the stock market. The challenge has been the bond market because of what higher growth, higher inflation potentially means, or a slower rate of cooling of inflation, and where that ultimately manifests is what is the Federal Reserve going to do, and the market's response to that is we expect them to do interest rate cuts, but maybe fewer than what they did 6 weeks back.
Excellent. Thank you, George. Paul, maybe just kind of building a little bit on what George is saying there and just thinking a little bit around actually what we've seen within asset markets. So how did they perform as we were coming up to the election? How have they performed since?
Yeah, I suppose if we think about how we invest here at True Potential, we're very much multi-asset investors. So we have to, I suppose, stock markets get a lot of attention, but we equally have to focus on fixed income markets and also currency. I suppose coming into the election, I suppose markets had, we've seen a little bit of weakness coming into the election, but we have to remember that it's coming off year to date. Equity markets have been particularly strong, so we've seen exceptional returns from most markets, but particularly the US. So I think investors were getting a little bit more nervous coming into the election, as it typically is the case. But following the election, we saw quite a divergence between what we saw within equity markets, but also within equities and fixed income markets. So starting with US stocks, we saw exceptional returns on the day. So US market, depending where you look, up 2 to 3%. As Faye mentioned, small caps were particularly strong, up around 5 to 6%, really helped by the prospects of deregulation within the banking sector and also greater lower tax rates as well. So US equity market's very strong, and that has been our preferred equity market for the last 18 months really. Global equities outside of the US is more mixed. So initially we saw a positive reaction within the UK and European equities, but as the day progressed we actually saw the UK finish flat and European equities were actually down around 1%. Why is that? Well, the prospect of tariffs being put on Europe means weaker economic growth, weaker inflation. We actually saw within the bond markets slightly different picture, almost the opposite. European bonds actually rallied given that weaker growth prospect, but US Treasury yield, US government bonds actually fell quite notably. Reason behind that is, as George talked about, stronger growth, more inflation, but also importantly, more fiscal government spending at a time where fiscal deficits are already at historic highs. That means greater government bond issuance, more supply. That supply has to find a home, and equally it results up in lower prices, higher bond yields. So weakness in US Treasuries, but European bonds performing better given the weaker growth prospects. I suppose outside of equities and bonds, what do we see in currencies? The US dollar actually strengthened quite notably against the likes of the pound, the euro and the Japanese yen, more than 1%. Why is that? Well, expectations are that the US economy will be stronger with Donald Trump in charge and the rest of the world will be weaker. That's because of higher tariffs being put on not only China but universal. So that would be a challenge.
Excellent, Paul. And Faye, maybe just from yourself, I know you spend a lot of time talking to the individual managers that we work with. Paul and George talked about our view, wanting to be overweight equity, overweight US equities. That's been exactly the right thing to do. But maybe just over the last day or so, what have you heard from the managers that we work with?
Yeah, sure. So we've seen a little bit of trading, but not, massive moves. I think Trump's policies and the impacts on markets that Paul's talked about, that actually aligns quite well with how we're positioned and also how our managers are positioned. So positive for the US, maybe less positive for the likes of Europe. Obviously TPP, where overweight equities via the US, and actually a lot of our managers are also overweight the US or have a US bias towards their equity book. So Close Brothers, for example, they're a stock picker. They have quite a lot in US companies, quite a lot in mid-cap US companies as well. So could be beneficiaries of some of those policies. Goldman Sachs as well also have quite a large US bias. So they are already positioned, in ways that could benefit from the policies. If I was to bring out an example of one of the manager changes that we've seen yesterday, would be just from UBS. So they actually put on a relative value trade within equities, which is, so they've not changed the overall level of their equity exposure, but what they've done is just chosen to overweight US equities and then fund that by underweighting European equities. So again, plays into that theme of stronger US growth, maybe a little bit weaker European growth.
Excellent. Thank you, Faye. And then obviously the True Potential portfolios, George, are made up of those individual managers. Is there anything that you're thinking about as one of the managers of the True Potential portfolios around positioning in respect to the US election?
Maybe just how they navigate the bond market from here. So one of the things that was quite encouraging was managers starting to move from an overweight allocation to US government bonds back towards neutral. So they did very well out of US government bonds, but when we started to see the risk that actually you would see bond yields move higher, they were taking that exposure back. It's just been interesting to see how they deploy that capital from here. One of the areas that they have been sort of incrementally doing it is in the gilt market, just as gilt yields have backed up after the budget as well. So I think the bond market's going to be quite an interesting development in the portfolios from here. Our view is to be a bit more neutrally positioned, just given the sort of balance of risks that we see. Still quite attractive yields out of government bonds if you hold them for a period of time. But in terms of the return which you can offer, I think we've had great returns out of the asset class, and maybe the fact that there's a lot priced into in terms of interest rates where we go from here to one, just to keep an eye on.
Thanks, George. Maybe just sticking with yourself, Paul talked a little bit around the kind of moves that we've seen in the dollar, just maybe from a TPP perspective, but also maybe highlighted some of the managers, just how they think around currency overall.
So currency is a really relevant part of the total return. So what we do is we don't put all of our clients in one single currency. We provide a range of different currency exposures. So sterling is the dominant currency because we're in the UK, but for a balanced portfolio it makes up about 70% of the total currency allocation. We've got about 15% in the US dollar as well. So what we do is just try and diversify portfolios so you can just not be held at the mercy of one single currency move. Obviously what we've seen with Trump coming in is a stronger dollar. That is in line with the view of some of our managers who potentially hold a little bit more dollar allocation, but ultimately we're sterling investors, so we need to bring it back to sterling for our clients.
Excellent, thanks, George. And maybe if I just stick with you with one last question, if you don't mind, which is, Faye obviously discussed how the managers she felt were actually quite well positioned. Is that the same for TPP?
Yeah, I think so. I think, but think about what our core themes have been. It's been nominal economic growth, resilience, and in that you want to be overweight equities relative to bonds. That's exactly where we've been. It's been about inflation cooling from the peaks that we saw 18 months ago towards the 2% level. That is the direction of travel which we've seen. We will also right in our view that actually we think 2% is quite a strong target for them to hit. Inflation's probably likely to sit slightly above that. That's exactly what we've seen, and it's probably a little bit more evident now with the developments we've seen from the US. All those policies which Faye's discussed potentially lead to inflation remaining a little bit more stubbornly high. And then along the way, this concept of a productivity impulse, which is essentially businesses investing in themselves, improving their efficiency and seeing profit growth out of a broader range of sectors, not just technology in the US. A lot of these are feeding through. think about the response which came through in markets around the sort of mid-cap US stock market, seeing real strength come through in that market. It's, we haven't seen vast breadth across markets, but we are seeing some signs which are a little bit more encouraging there. So are we positioned well for that? Yes, overweight equities, dominant channel being the US, have taken our duration back, or our fixed income allocation back towards neutral, and we've got an underweight to areas such as cash and alternatives, and that's been the right call. Is that the right call for tomorrow? Well, I think a lot of the developments we're seeing economically are feeding pretty well into our base case. But I mentioned bonds, and that's an area which on the team we're debating quite a lot at the minute in terms of what our optimal allocation is. I think at this point probably neutral is about right.
I suppose just to add to that, you've got your selection of managers to use, but each of those managers are active managers. Navigating this environment, picking up the opportunities where they see them, but also, of course, keeping an eye on the various risks that are out there.
And Paul, maybe just to finish with you, just from a growth aligned perspective, so obviously you are one of the managers that sits within the True Potential portfolio proposition. When you think around your positioning right now, is that very similar to what George has discussed? Is it overweight equity, overweight US equities, maybe a little bit more nervous around fixed income compared to say 2 months ago within the sovereign sector?
Exactly. That's couldn't have said it better myself.
Perfect. Excellent. Well, look, that is everything from myself, from George, from Paul and Faye. But just really to summarise the discussion that we've had. So Donald Trump, what do we see? Well, we see Trump's policies as being good for economic growth. We believe that nominal GDP will stay high. What we believe is that inflation may marginally tick up from where we are right now. Positioning perspective, we have been positioned very well in respect of the True Potential portfolios and the managers that we work with. We haven't seen a significant amount of change, but actually that's because the managers have been positioned correctly for what we've been seeing within the US election overall. So for us, as always, we will continue to look after your money. We have the privilege of looking after your money overall, and we look forward to speaking to you soon. Thank you very much.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.